Most people think the biggest investing mistake is picking the wrong stock. It's not. The biggest mistake happens before you buy anything. Picture this. After months of hesitation, you finally invest some of your savings. For the first time, you feel like a real investor. You stop watching from the sidelines and put your money to work. Then, 3 weeks later, the market falls. Your account turns red. The money you spent years saving is suddenly worth less than it was when you invested it. And just like that, the confidence disappears. Your brain starts asking dangerous questions. What if this keeps falling? What if I made a mistake? What if I lose everything? That single experience stops millions of people from investing for years. Not because they chose the wrong investment, not because investing doesn't work, but because they started the wrong way. And if you are thinking about investing this year, understanding that difference could save you years of frustration and potentially thousands of dollars. Because the real risk in investing is not what most people think it is. There is a story people tell themselves before they invest. They say they're waiting until they have enough money, waiting until they understand the market better, waiting until the timing feels right, waiting until they feel ready. But while they wait, something else is happening. Inflation quietly reduces the purchasing power of their savings. Years pass, opportunities pass, and they watch other people steadily build wealth while they remain stuck preparing to begin. The problem isn't fear. The problem is misunderstanding risk. Most people think investing is a choice between safety and danger. They believe keeping money in cash is safe and investing is risky. But that's only part of the story. Leaving money untouched for decades carries risk too. The risk that inflation outpaces growth. The risk that retirement arrives before your money is ready. The risk that your future opportunities become limited because your savings never had a chance to compound. Real investing isn't gambling. Real investing isn't chasing hot stocks. Real investing isn't hoping for luck. Real investing is building a system. And that system begins with one concept that almost nobody talks about. Your investable surplus. This is the money left over after your essential expenses are covered, after your emergency fund is fully funded, after your short-term obligations are handled. This is money you genuinely will not need for years. Not your rent money, not your emergency fund, not next year's vacation money, not money you'll need if something goes wrong. Only money that can remain invested through both good times and bad. That distinction changes everything because most investing mistakes are not investment mistakes. They are cash flow mistakes. When people invest money they may need soon, every market decline becomes an emergency. When they invest money they can comfortably leave alone. Every market decline becomes temporary noise. And that difference determines whether someone panics or stays invested. Behavioral finance researchers have studied this for decades, again and again. They find the same pattern. Investors are often their own worst enemy, not because they lack intelligence, because they are human. A psychological bias known as loss aversion causes losses to feel significantly more painful than equivalent gains feel rewarding. In practical terms, losing $100 hurts far more than gaining $100 feels good. So when markets fall, emotions take over. People sell, they lock in losses, then they watch the recovery happen without them, and afterward they conclude that investing failed, when the reality is that their behavior failed. This is why successful investing starts long before the first investment. To see why, imagine two people, same income, same age, same year, both decide they want to start investing. The first person hears that time in the market beats timing the market, so they move quickly. They transfer a large portion of their savings into investments. At first, everything feels great. Then life happens. A medical bill, a job interruption, a family emergency. Suddenly they need cash. The market happens to be down. Now they are forced to sell at a loss. Their confidence is destroyed. Their investing journey ends almost as quickly as it started. The second person takes a different approach. Before investing $1, they build an emergency fund, 3 to 6 months of expenses, separate, untouched. Then they identify a small investable surplus, an amount they know they won't need for at least 5 years. Instead of trying to get rich quickly, they buy a simple low-cost index fund. Then they automate contributions every month. Without fail, when the market drops, they don't panic because they planned for uncertainty from the beginning. Same market, same economy, same opportunities, completely different outcome. Not because of what they invested in, because of how they prepared. This is where many people get stuck. They believe confidence comes before action. It doesn't. Confidence comes after experience. Nobody feels comfortable investing before they start. The comfort develops later. That's why one of the smartest strategies for beginners is starting smaller than they think they should. A small investment teaches lessons that books never can. You experience gains. You experience losses. You learn how your emotions respond. And most importantly, you discover that market fluctuations are normal, not emergencies. Another powerful tool is automation, because investing is often hardest when it feels like a decision. Every month, you ask yourself whether now is the right time, whether prices are too high, whether you should wait, whether a crash is coming. Automation removes those questions. A fixed amount goes into investments on a fixed schedule. Some months, you buy high. Some months, you buy low. Over time, those purchases average out. And more importantly, the habit becomes stronger than the emotion. That is how wealth is usually built. Not through brilliant predictions, through boring consistency. Now, fast forward 20 years. One person spent decades waiting for certainty, waiting for better timing, waiting to feel ready. Their savings account grew slowly. Inflation quietly took its share, and they wonder why financial freedom feels farther away than they expected. The other person started small, stayed consistent, ignored the noise, survived the crashes, stayed invested through the recoveries, and eventually finds themselves looking at a portfolio that seems almost unbelievable. Not because they were lucky, not because they found a secret strategy, because they gave compounding enough time to work. And that brings us to the deepest lesson in investing. The obstacle isn't money. The obstacle is identity. Many people think investors are different, smarter, wealthier, more sophisticated. So they wait until they feel like an investor before they start. But that feeling never arrives first. The identity follows the action, not the other way around. The moment you invest your first dollar with a clear plan and proper structure, you become an investor. Not because of the amount, because of the decision. So, if you want to move from saver to investor without risking your life savings, remember the sequence. Build your emergency fund. Define your investable surplus. Start small. Automate contributions. Choose simple, diversified investments. And then do the hardest thing in personal finance. Leave it alone. The market will test your patience. It always does. But the people who ultimately succeed are rarely the ones who predicted every crash. They're the ones who built a system strong enough to survive them. That isn't a secret strategy. That's the entire game. And if you're serious about building wealth the smart way, not through hype, not through gambling, but through proven principles that actually work, make sure you subscribe to Zero to Wealth. Every week, we break down investing, personal finance, and wealth-building strategies into simple, practical lessons that help ordinary people make better financial decisions. Because building wealth isn't about finding shortcuts. It's about understanding the rules of the game and applying them consistently. So if that's the journey you're on, subscribe to Zero to Wealth and join us for the next lesson.